maybe you could summarize the view that you've heard from your speakers the last couple of months, let's say.
I think that a lot of my speakers have been saying that with tariffs, there's not just going to be a disruption in the flow of goods and to a lesser extent services, mainly goods, but also of capital. So we saw that like uh, Japanese investors selling out of the bond market in early April. That's definitely tempered down, and basically, I think that it's basically not just going to disrupt trade; it's going to disrupt capital markets. And George, honestly, I feel like the bulls were kind of nowhere to be found, and even people who are kind of perma bulls were, you know, throughout the middle of April being, jeez, did I? What?
Hello?
Hey, sorry, I thought my connection was dead.
No worries.
Even
No, we're good.
even the bulls, even people who the perma bulls were getting very cautious in the middle of April, and that probably was with the benefit of hindsight, probably a short term buy signal. But yeah, I don't know. I just feel like there's so much uncertainty and so much hinges on tariff policy. Like I honestly, George, can't really think of what the market's trading off of other than tariff news flow.
Well,
I
that's
mean,
that's a very honest answer, Jack. Because I think anyone who thinks they know is fooling themselves. I mean, there were people who got the down right and been caught in the up. There are people who had the upright and got the down wrong. I mean, Thorne's been jumping from one lily pad to the next because he happened to get the down right and the upright, but he's like the exception, not the rule. And so it's just very hard. And so, Jack, imagine what it's like. I mean, it's one thing, if you're just talking, whatever. You imagine your own money. You don't, okay, fine. But imagine you're trying to run like real money, or imagine even worse, you're trying to run a real business. Like, how the heck are you supposed to do this with this type of uncertainty?
I think if you're a hedge fund, I think the answer is you know scale with volatility. So as the market gets 10 times as volatile, you should reduce your positions by 90%, and then when it gets less volatile like it is now, you gradually scale up. I think if you're a business owner, a real bonus owner, not like a media company like me, but then you have to take pause. You say, what? Wait, what's am I going to factor in that tariffs are going to be 145% forever? Oh wait, Trump just said that they're not going to be that. Oh wait, actually now they're going to be. Oh wait, Scott Bessent's in Geneva. Oh, it's just so much uncertainty, and I think that is what could cause a slowdown. Is just people not doing activity in terms of capital spending. I think in terms of buying, actually, you saw a short term acceleration. And by the way, George, thanks for letting me know and everyone that Tom has been seeing the ball very clearly, because I actually didn't know that. So that's really good that he got the down right and the upright. By the way, I'm one of those people, probably one of many in these rooms who I got the down right, but I got the up wrong. So yeah, that's my position.
Yeah, and Jack, you just touched on another thing too, is timing. Everyone's got different time frames, and that's one of the things I really, one of the things is so tough about Twitter. You may be bullish and Joe may be bearish, but yours is a 1 month call and his is a 1 year call. And then it's like ships in the night. I mean, it's a multiple time frame type of undertaking all the time. And people just, there's that meme, what is it? Arguing with people on the anonymous strangers on the internet or something like that. So people get totally amped up over time frames. They get totally amped up over, oh, you got this call wrong. So let's say, for the sake of the argument, all right, Jack, you're, in baseball, you can make it out 70% of the time. You're a 300 hitter and you get paid tens of millions of dollars. All right. So let's imagine, you're leading the league, you're batting 330 or whatever. And some jackass who's just a hater comes out and says, "Oh, look at this. Farley got up, he got up three times and he made two outs. Can you believe it? I mean, what an incompetent." People are just. It's one of the things I just really don't like about Twitter. But so there's time. So, but as you know, Jack, as opposed to running money, where it's nobody really sees what you're doing. You're only answerable to yourself. I mean, it's very important not to let your ego persona get caught in the game. I know that caused me trouble a couple years ago, but I think it's important too. And Jack, have you had this happen to you? I'm kind of ranting here a little bit, just thinking about all the speakers I've had on. Have you had situations where, and again, we're gonna keep it anonymous, but people come so vocal that instead of they own the position owns them. Like, you're Kathy Wood, like you have to be bullish, okay? Or you're George Noble, end of 22, you have to be bearish. Jack, you wimped out on me again. You got to come back. So there's this whole prop. Jack, why don't you leave and come back? Dilly, what is going on with this space?
I think we called it Twitter too many times.
God Almighty! All right, well,
Elon's listening. Maybe we should try just going forward with the space, calling it X, and see if that stops the
yeah,
glitches.
or the bull case for Tesla. I don't know. Well, Jack, if you would please leave and come back. While we're waiting for him to leave and come back, Tommy, if you're there, maybe you just want to weigh in on what do you see going on? Tommy, good to see you. What's going on?
Hey George, hi Dilly. You know what?
Hi.
Hey, I think that, and I have a, actually, I've been interviewed by Jack a bunch of times, and I really want to ask him some questions that I think will be really informative for everybody. As far as like the current environment, I mean, look, we've got a market that you've had a several year bull market where everyone is over eager to buy, and they don't look at fundamentals. They are on spaces that are, what are we buying? What are we buying? And everything is just so over eager. And one thing I'm gonna mention to Jack is that a lot of times, you see these really, maybe it's in my YouTube feed, but it's these like horribly, the end of the world is coming. What do you do? Listen to so and so. But the way I look at it right now, uh, I've sort of neutralized my portfolio, which means I have almost an equal number of longs and shorts, and I've raised cash by taking some both off. My shorts that I have right now are not that great. Which if they were, I'd be pretty stunned. I have a short in gold and or GLD and GDX, which are doing okay, but everything else has gone straight up, and that's okay because the longs have outperformed. But it's really one of these markets that I think is really important to, and I think Jack touched on it, where you don't know necessarily, you don't have the you don't you shouldn't have this high, you shouldn't have high confidence of really anything lasting with when you have political turmoil and political comments and tweets and truth socials that are moving the markets. It drives me absolutely nuts. And
Yes.
maybe some of this uncertainty with China and the tariff reduction will cause a little bit of more calmness. But I'm really very interested to see how things trade over the next few days. If it's a
Yeah.
sell the news, then we've got some issues. But um,
Tommy, let me interrupt
is
you.
Jack there?
Jack, yeah, Jack is back. So Tommy, you had a couple questions you want to ask Jack, so I'm going to let you have at it. Tommy, you go for it.
Okay, but I see him as still a listener. Can he
No,
talk?
he's a Jack is a
Okay,
speaker now. Jack,
okay,
you there?
I'm here,
Yep.
Tommy.
okay.
Go ahead, Tommy.
All
Go
right.
ahead.
Well, first of all, I just want to say congratulations to Jack and Max, both two guys that I've known from the old Real Vision days before it was Raoul Vision and Crypto 24/7. You guys always have done amazing work. You ask great questions that elicit, usable answers. So I've always been very, very happy when I've done interviews with you guys. And I just I have a couple things well, I have a couple questions, and it's sort of like who was the best guest and the biggest get and stuff like that. But why is it maybe it is my YouTube feed where I am like I see these like dire headlines like the end of the freaking world is coming. This is what you should do. Like there's a lot of, I guess it's clickbait. And, you know, just, I find that to be a little over the top when you're looking at these videos. And I hope that people will start to get the drift that it kind of drives people away. Jack does not do that. Jack is pretty measured with his stuff, and he's got some great guests. But okay, so Jack, who is the best guest you've ever had? And I'm gonna this is sort of a
Yeah,
speed session here.
Tommy. I think maybe who are the best two or three because the best is it's a lot of pressure. I mean, I
Okay,
don't know,
okay.
whatever.
So and
George Noble. No, just kidding.
No, come on. You haven't had me on yet, Jack. Keep saying you will. Go on.
Yeah. So first, Tommy, thanks for saying those nice things. I think that I don't people like doom and gloom. People are attracted to chaos or the potential of chaos.
Mhm.
Like in a light bulb, like a fly is to light. But I think that my content is I hope deep and balanced and not biased. But in terms of the thumbnails, Tommy, I might be creating some of those thumbnails because I'm quite ruthless in terms of having a content having a clickable thumbnail that I think people will click on. Ultimately, the content is deep. You'll attract them, and if I don't do that, then people who their thumbnails are clickbait and the content sucks, then those people will beat me. In terms of the best,
Okay. Jack, wait, hold on. Let me just make sure everyone knows that Jack is now on the Monetary Matters Network on YouTube, and you should subscribe right now. I mean, I have a great list of YouTube followers that I have, and Jack and Max are one of them with this. And I've watched you go from Real Vision to another one, and you now have your own, and I think it's super well deserved, and you have your subscriber base is growing, and I hope every single person on here will go on there and subscribe because you do get some great people. So go on. Sorry, did
thank
I
Yeah,
interrupt?
so Tommy, you pulled a George before we could answer the question. You interrupted him. We still don't know who his two or three best
Jeez.
speakers are. Go on, Jack.
man, it is tough. It is really tough.
Jack was hoping he could squirm out, but I remember the question, Tommy.
Yeah,
So,
yeah.
all right, Tommy,
Okay.
he doesn't want. He obviously doesn't want to answer. Tommy, go on to your
Who
next
is your
question.
bet?
Okay,
Who
no, no,
is
no,
your
no,
like
no, no.
top
I'll say I
top
gotta say
three
Joseph
best
Wang. So
guests?
I think Joseph Wang has nailed everything. He's really helped me understand the Federal Reserve. He's the person I've had on the most monetary matters plus forward guidance. I probably have had him on 30 plus times. And I don't think that some of this is definitely luck, but his market calls when I've asked them
All
for
right.
them have been really, really good.
So, Jack, I'm going to say this as a friend. I'm actually going to put this up in the nest. It was, Twitter. Everything's hilarious. You can't take it seriously. Like if you do, you go crazy. But I'm going to come right back at you, Jack.
Hit me.
Someone, this guy, Professor Satoshi, tweeted out yesterday, last night when all this thing went crazy. Mute yourself, Jack. You're kind of your mic's going nuts on us. It says Joe Wang is short, Citrini is short, Lecker Capital is short. All Kobayashi letter subscribers are short. Forward guidance listeners are short. Paul Tudor Jones is short. Stanley Druckenmiller is short. Point 72 is short. Morgan Stanley is short. Goldman is short. Retail investors won. So, I'm not throwing Joe Wang on a Fed guy under the bus, but it is most again showing you how like you can't be right all the time. I mean, I don't know. Is that inaccurate? What his last interview was with you?
So, George, I'm so glad you brought that up. I've got a lot to say. Definitely, there are some people in that list who I would like to be compared to, or who it would be honorable to be compared to. I actually think I should have been listened. I should have been listed in that list, and I kind of dodged a bullet. So I retweeted that and said,
Maybe they mistook you. Maybe they thought you were forward guidance, Jack. I don't know.
maybe
Whatever.
that is true. I met
Yeah,
someone
you
this
know
week.
what? You know what? Because people associate forward guidance with your name. I don't know. I forget who's doing it now.
Yeah, well,
But I want to.
the current host is great. Felix, he's Fijao on Twitter, and
Yeah. Okay. But
he's
I
great.
want to
No,
talk.
George,
I
George,
want.
no,
No. I want to talk about Fed guy. No. This is my courtroom. I
I'm
want to talk
getting
about
there,
Fed guy.
George. I'm getting there.
Go on. Go on.
I'm getting there. First of all, he goes by Joseph, not Joe Wang. And yeah, I don't know this, but I think he has been bearish. It was looking real smart, up until the bottom, up until recently, and now we're there. But what the S&P is, Tommy will know, but it flat on the year, or maybe the S&P is actually even up on the year. I don't know, but yeah, I guess he was seeing the ball very very clearly. But yeah, I think he's been quite bearish, and I think that's been wrong. So no, definitely.
No,
But
his end of year target in this podcast is 5,500 on the S&P. Just for the record, he said it multiple times. End of the year is 5,500.
okay, he said that in my podcast.
No, in his own, he does a weekly.
Oh yeah,
markets
yeah.
update.
I got it. Yeah.
Yeah. So he's a little bit down from here. He didn't. Nothing goes in a straight line. End of the year is 5,500.
Yeah, no, we're not taking sides here. I'm just trying to
Yep.
put clarity on this whole thing.
There,
And by the
I think that's true. Yeah.
by the way, Jack, apropos of that, I was talking to somebody who does an investment service, done a very credible job. Is up significantly year to date. Had the gold call right and some other stuff. Anyway, one of his customers called him today complaining because he's missed this rally. And as the memes would say on Twitter, the market soars to levels not seen since 3 weeks ago, however it would go, right? But anyway, this guy was really trigger happy, quick on the draw to criticize him for missing the up. But the funny thing was, he kind of quote unquote forgot to call him to compliment him for missing the 20% drawdown. I mean, that's just the nature of the beast. So, net, I mean, the guy's at a really good Sharp ratio and he's up handsomely year to date. But that's the nature of, social media and this business. Like, you're only as good as your last trade. So, do you find like the most thoughtful investors, I mean, the best guests to be ones who are, I mean, I don't know anybody who's trying to, in some of these spaces, it's like the stock of the week or the stock of the day. I mean, anyone who's talking or thinking in those terms, like I don't even want to. It's like brain rot. So what I really like about what you do is the perspective you guys bring on. The real investors are not all this shiny object. Why was Nvidia up 7% today? Who the hell knows? So anyway, let's go back to Tommy. Tommy, you have another question for Jack?
Yes. And I get it, Jack. I mean, sometimes it's tough to answer, these questions. I've tried to answer some of your questions, and but here I just am always curious, like who was like your biggest get? Like who did you get that you were like, wow, I can't believe I'm like talking to this person? And then like who blew you away? And then who would you like to get? Like a dream scenario, like three people you would love to get on an interview for an hour.
So who was the biggest get? I think it'd have to be Sheila Bair. For folks who don't listen, like former chair of the FDIC. So when read books about the Great Financial Crisis, she's always there, and I'm really glad I got a chance to speak with her. And yeah, I should reach out again because I should have her on the news show. When you said who blew me away, for a second I thought you said who like blew me off or like who just didn't respond to my email. That
Well, I would like to know who blew you off because I will have a word with
yeah.
No,
them.
I'm gonna overrule it. I'm gonna ask a different question, and it's always Jack. They say you can praise individually, but one should criticize only generally. So, without mentioning names, I don't want you to mention name. Being appropriate to mention name, you're not going to mention name. But have you had guests on where they were just it's a general question. So, have you had guests on where their reputation precedes them, and they come on, and you're like, what? Like seriously? Like you've been just like totally underwhelmed?
Yeah, definitely.
And also, is it also a function too of the market environment that one is in? Because let's face it, you're a public person. You do these podcasts 3 times a week. You got to have intelligent sounding guests on. You got to be unintelligent. But sometimes there's the market's totally baffling and confusing. Sometimes it's like boring and watching paint dry. There's really nothing to talk about. Other times there's like ideas all over the place, and you regret the fact you only got an hour to talk. So I mean, the opportunity set's not linear. So does that therefore, when you think of the cadence of the markets, does that kind of dictate? Sometimes, like when you're doing a space, it's like, oh yeah, like what am I going to talk about? I mean, you want to have another guy come on talk about the dot plots and the Fed this and my GDP number is, 0.2% higher than yours, and blah, 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 blah. And it's all kind of like macro gobbledygook with no investment conclusion. Like, how do you avoid that?
That's a really good point. I think it's more common on, well, frankly, TV, but also like a lot of investment newsletters or so-called investment newsletters actually are just like a bunch of like it's like every research note is like a novel, and that's something I really like about Tommy's research service is like it's very clear what his views are, and there's very little frill. There's very like little flowery ornate language. It's like I don't need a historical analog. I don't need a poem. I just need your thoughts and what you think and
Okay.
why.
All right. So,
And yeah, I definitely see that in the newsletter business and
all right.
the investment newsletter, and frankly on TV. Like a lot of people will say, I mean, for example, there's an oil specialist who you'll have like people on TV who have told me that like they get questions about the oil market and they're like, oh well, how come how come Hess you know uh Hess has the greatest like offshore exposure, and he's like, no, Hess is like not. So basically, yeah, I think it's basically impossible to get a detailed answer in like a 5 to 10 minute interviews, and that's why um, I don't like them at all. I think, by the way, the best person who does like I call them short form interviews, but like TV by far, Jonathan Farrow on Bloomberg is just so good at that, and I could never do that. Basically, be true and be accurate, but also get it
Right.
be quick and allow people to get
Right.
into the depth.
So Jack, there's a fine balance. One of the things I like, I mean, you ask really good questions. God, this is like talking to a Jack Hall of Fame testimonial. Like, Tom, you got to be careful. Like I was starting to cringe a little bit. There was too much of a bromance going on there between you and Jack. But Jack, you asked really good questions. And also, you do not make yourself the center of attention. You try to make it about the speaker. Um, Sometimes, though, when you're sitting there and the speaker's like making no sense to you, let's say it just it's opposed to every visceral feeling you have. Like, are you like, and you want to really disagree with him? You just kind of like bite your tongue, or you'll gently try to tease out of him, like, could there be another interpretation? Like, what do you do when you just think the guy's like, at to lunch or just doesn't know what he's talking about?
I think that over time I've gotten way more of asking questions and basically challenging the guest, and even so that now sometimes like in the comments people kind of regard me as a tough question. But I'm not playing hardball at all, or definitely not doing gotcha. I just want to help people understand. And some guests have said like, wow, you're really like taking me to task on this, but in a hopefully polite way. I mean, one line that I think is a good thing to say, just to give a sense, and I actually got this from Grant Williams, co-founder of Real Vision, who's great. And he said, just help me understand. So, George, if you were saying that's something that to me was sounding like total nonsense, I could say, but George, what about this? What about this? But the much more polite way to say it is, George, help me understand this. Like, to me, it seems like what you're saying doesn't make any sense. Help me understand. What am I missing?
Right.
That's the way to put it.
I think you used that phrase about 15 times with George Robertson when I listened to you interview. So
Oh my lord.
Hey Jack. Hey Jack. So and just one more little compliment because it's a bromance. Someone because I wrote this
Thornton,
down
what is going on with you, man?
before this.
Thornton, what?
No, I
No,
know,
why don't you ask him?
but one of my
Go on, go on.
one of my all-time favorite people that I worked with years ago, who runs a long short value fund, who I would actually really like to get on a spaces or and long, probably really long form with you, Jack. Um, he's one of the smartest guys I know, and he said he sent me so many. You got to watch this Jack Farley interview with so and so. Just so smart, and you've always asked very pertinent questions. So I am going back to because I really want to know, like, if there were three people, dream people to get on your uh, for you to interview, who would that be? You can give me one, you can, random, whoever. Don't think about it too long. Who would you like?
Stan Druckenmiller. Tommy, you got him tongue tied. Either that or his mic is blown out again.
Yeah, I think I did.
can we stop with these top three
Yeah.
questions?
All right. All right. All right. So let Joe. Good to see you. Let's just move along a little bit. Give Jack time to clear his head. What's top of mind for you, Joe? What's noteworthy? What are you thinking these days, Joe?
I guess I want Jack's reaction. I really wanted to get his take on some of the developments. Obviously, the most recent developments on the tariff front today. So I was hoping we could get to some market talk. I don't know
If his mic is working,
not
Jack, are you there?
yeah.
Jack, we can't hear you. Jack, can you leave and come back again? This is like ridiculous. Oh God, I don't know what is going on with this app. This is so god awful. Anyone else has questions or statements they want
I'll tell you
to?
this, George. The people that what I've found are the people that who voted for Trump think it's genius, and the people that didn't vote for Trump think it's just a complete capitulation. It's right down the middle from what I read today, doing a little scan of on Twitter. It was just right down the middle like that. But yeah, I would like to know some of the stuff that Jack's thinking right now, because
All right,
Jack
I'm here.
has
Wait,
a
first of
lot of
all, so I
views.
think people can hear me. Yeah.
We got you. Yep.
Yeah.
Yeah,
Okay.
we couldn't hear you.
Thanks. Stan Druckenmiller, Howard Marks of Oaktree, and then Mark Rowan of Apollo. Okay. Now, as to what I'm thinking now, the before we get it out of the way, yeah, I've got no idea. I think very, very few people know what's going on. A thought that occurred to me. Okay, first of all, and I think Tommy, you probably have this as someone you're an investor, a trader, a market strategist, but you also like get exposure to a lot of people's opinions in a way that a lot of people don't. I'd say most people do not get access to, and I have the same thing. Like I have access, or to a sense of how my audience is thinking about the market and how people in general are thinking about the market. That I think I'm kind of like to opinions as to what like a trader at a bank would be to bonds or stocks or certain assets. Like I'm seeing the flows of opinions. And I guess you don't have to have a podcast to track it, but I think I do have a good sense on what people are saying, and based off of that, I do think that like with the benefit of hindsight was like, people were quote unquote too bearish. Like, but I believed it. I believed it too. I was one of those people who was very, very bearish, just like looking at what's happening to global trade. I think President Trump blinked, and I think that he will just declare victory and say that he extracted some major concessions from foreign nations. Here, look, I've like Tommy probably. I've been driving myself crazy, like listening to every single press conference that Trump does. So you know, I think I've listened to pretty much every one over the past month and a half, and there are constant things that he says, like other countries are ripping us off. The fact that there's a trade deficit is evidence itself of that we're being ripped off, and that they don't accept our goods. And I think originally, I don't think even Trump said this, but it was kind of implied, and other people said this, that other countries have high tariffs on us. And I didn't know that a month and a half ago, but like a month and a half ago, the world started cracking because of tariffs. So I looked into it, and really, other developed countries do not have very high tariffs on us. Like the only large economy that has systemically high tariffs across the board is India, and they're actually a friend. And this is another thing Trump says. He says friend in some cases has been worse than foe in terms of trading relations. So I think that the real barriers, who think that there are barriers, I don't know, have to be non-tariff measures. Like there actually was a people were talking about it mostly on the right, on the conservative side, the pro-tariff Trump wing. We're talking about, they're playing a video of Nancy Pelosi in the late 90s with a billboard in front of her talking about like, we can't let China enter the World Trade Organization. They're going to ruin our labor. They're so unfair to us. How come we can't have tariffs if they have tariffs? And I found that argument convincing. But if you actually look at the board shows that uh, China's tariffs on the U.S. in 1999 or the late 90s were 35%, and now they're 5%. And there's certain goods like Canada has ridiculously high tariffs on milk, or 200%. I'm just making that up, but that doesn't mean, you have to look at what is the actual average tariff rate. And for the vast majority of rich countries, they're in the single digits. So us having 20, 30, 40% tariffs, and that they're way higher than the rest of the world. And you could say maybe we need higher tariffs on the rest of the world than the rest of the world puts on us, because we're, as an economy, we could consume so much and we produce so little, or the gap between how much we consume and how much we produce is so huge that we just need to restore those imbalances. I did an interview with Ken Rogoff, economist, and he was chief economist of the IMF from 2001 and 2003. And really, if you like, as an economic historian, if you look back at the early 2000s, like that was just it's a very, very good time for China and the Chinese economy. But like, there's not much to like about the U.S. economy from the early 2000s. Like the trade deficit just exploded, and like all of the growth in the economy was a huge growth in consumer debt, private sector consumer debt. And so I think that's probably one of the worst economic periods. Obviously, the great financial crisis was good, but that was really bad. But that was a build up to it. So I think like the imbalances that President Trump is attempting to address, that I mean, there are real imbalances, really stem from the early 2000 periods, and literally 2001. That's when China joined the WTO. And so Ken Rogoff, people should listen to the interview. It's on my pinned tweet, and he also wrote a book about it. And the book has got these great anecdotes. Like he literally talked to the head of China, like the version of Xi Jinping today in 2001 or 2002, and said like basically, you know, there's a huge imbalance, a huge trade imbalance, and China needs to consume more and stop exporting so much. And Ken Rogoff was able to bring his children, his daughter and his son, and in the meeting with the the head of China, his son fell asleep. So that's a that's kind of okay. That's a detour from what am I thinking right now. But I mean, look, in the long run, stocks go up, and I don't. Okay, I think also the U.S. economy is very service driven. So I think that that's like 80%. I don't think services will be impacted really at all unless we get a scenario where like Europe is basically like canceling MasterCard and Visa or other very profitable American companies that are service based that basically extract profits from the rest of the world. I don't does not look like we're heading there at all. But okay, based on what Trump has said over the past month and a half, like I think that if you had I'm surprised at this deal making. Like it's tough to read him. I think maybe Trump played an art of the deal, maybe not on China or on Europe, but on me. That I thought that he was very very serious, and now he's going back, and I think it's a good thing that he's going back. But it appears like he's going back, and yeah, I
Why do
think
you,
he's a
Jack? Why do you think so many people had that blind spot? I mean, especially those who traded through 2018 and saw him, giving policy by tweet on a China trade war previously. I mean, again, even his own supporters, I think, will, if you ask them, they'll say, "Listen, you don't need to take the guy literally. He has a directional idea for public policy. He wants to go in a certain direction. He believes, right or wrong, that the United States is getting screwed, getting ripped off." Why does everybody? I mean, you were saying I listen to every single press conference. Honestly, I try to tune out as much as possible because I think it's mostly noise. I mean, you hear contradiction after contradiction coming from the administration within administration officials themselves. So I guess I don't understand the virtue in trying to read the tea leaves of someone who ostensibly doesn't seem to have any rhyme or reason.
well, you're saying that you are reading the tea leaves and you've been correct, but what how are you supposed to know that he was I mean, you were right, but
No, this isn't about me
basically
being
you
right. I'm just saying I don't understand the people that think that you can gain meaningful information given the cross signals you get from the administration. That it's not about any Joe being right or anybody being right. How can you gain meaningful information when
No,
there's been a penchant for, I guess,
let me, Joe, let me just step in. I had Jay Pulaski, former Morgan Stanley emerging market strategist, had him on a YouTube a couple months ago. We had him on a space a few weeks ago. And he actually said, he's on the other side of the political aisle, but he said one of his superpowers, and he wasn't being trying to be cheeky or anything like that. One of the superpowers he had was ignoring what Trump says. Because if you want to analyze what's really going on, don't listen to him. So, and I tend to concur with you, Joe. So, no, and by the way, the other thing too, I think Joe's thinking about context here. I mean, things have been. Trump has been so unpredictable. I mean, let's just wind the clock back. Joe, you're old enough to remember when back in January, okay? Or you're old enough to remember in the first administration. Everyone comes in. Oh, he's worried about the stock market. There's a Trump put. Blah 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 blah. Nobody had it on their bingo card. The narrative changed really quickly to, oh, he's got to get yields down because it's deficit. The hell with the stock market. Blah 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 blah. And all of a sudden, that's the party line. So everyone's on one side of the boat. Now we're jumping back to the other side of the boat. I mean, I go back to this analogy I keep using about, a drunk driving down a snow covered mountain road let's say I'm driving, Joe, and you're in the passenger seat, and we go far to one side of the road. We're gonna hit one guardrail. You yell, George, George, quick, turn the wheel the other way. So I turn it back the other way. We head for the other guardrail. Well, turn it back the other way. So on the one hand, yeah, he wants to get the bond market up, interest rates down. So that's supposed to be what he's concerned about. Next minute, the market goes down too much, and everyone searches for the Fed put or the Trump put on the stock market. And so, I don't think it's useful to ascribe meaning. I also happen to think, is parenthetically, that there is no 6D chess or 10D chess. You're just kind of winging it. But that's not. I don't want to even go there because then you one triggers all the Trump supporters. It's a highly unpredictable market, and anyone who thinks they really know what's going on is either lying or fooling themselves. Joe, back to you.
Yeah, no. So look, I mean, somebody expressed a fondness for Howard Marks earlier. Howard Marks says you can't predict, you can only prepare. Right. And the reason why that's significant is like, look, if you're going into moments where higher volatility, that has obviously, if you're running money, right, that has obvious repercussions, right? That is degrossing. Like, there's real things you can do, okay, in that environment. But the notion that someone can perfectly call this and know what the president's thinking on this, when I don't think, quite honestly, and feel free to disagree with me, but I don't think he knows what he's trying to
That's
accomplish in
what
terms of his.
that's what just saying. I don't think he does. I think he's just responding in the moment. And by the way, I want to be very careful how I say this. I said before, one should praise individually but criticize only generally. I'm actually going to be critical of Howard Marks. Not because this is maybe just my experience. Maybe yours is different, Joe. I don't know. But he's very smart. Obviously, he's created an incredible firm. He's generated great returns. But his commentary, while it may be interesting or folksy, um, I don't find the information ratio of his content to be particularly helpful in informing my view about markets. It's just so he's a great investor, but there's some great investors who just don't want to give their cards away. I can think of a few in particular. I'm not going to mention them by name. Some of the smartest investors in the world will not tell you what they're doing, nor should they if they don't want to. And there are a lot of people who aren't good investors. They'll tell you everything they're thinking. All right. I don't find, for instance, let me juxtapose Stan Druckenmiller with Howard Marks. They're mentioned in the same breath. And I have a similarly high regard for both, though I think Stan is the greatest of all time. I defy anyone to tell me that Howard Marks's commentary, while they're lovely to read, is remotely as helpful as Stan Druckenmiller. Agree, disagree, Joe?
Yeah.
I'm gonna jump in and I'm gonna disagree, but I want to hear Joe.
Yeah, no, I would tend to agree with you, but I take everything, I just absorb it, and I take what I like and form my own thesis. I don't really. When you say helpful, I guess that's where I have a challenge. Not to give you a lawyer response, but like, what do you mean by that? I mean,
Joe,
I
Joe,
enjoy
Joe, 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 Joe. It's that the
actionable. Do you mean actionable? Is that how you're using it?
yeah, that doesn't mean stock of the week either. But look, like, what am I supposed to do with this? Okay, in other words, after you read it, okay, am I any more inclined to want to do this or that or whatever? All right, and like we were talking about earlier, there's some guys who are great. I'm going to go back to some stuff I Treaty said in this space a couple weeks ago, and this is a very useful construct that stayed with me. And Jack, I think you'd recognize this if you haven't heard this said before. There's some information which is descriptive. It tells you what already has happened. It's like reading yesterday's Wall Street Journal or the paper from 3 weeks ago. Then there's information which is predictive. It can be right or wrong, but Stan Druckenmiller tell you thinks the bond market interest rates are going to go up or they're going to go down. Okay. And then there's information which is prescriptive. Okay, rates are going to go. Stan made a good case why rates are going to go up. I agree with that. Let's just say hypothetically, you agree with that, Jack. What am I supposed to do with that? Am I supposed to go buy short bond futures? Should I be buying? Should I be shorting the short end, the long end, or maybe I should be shorting home builders because they haven't discounted the horrible fundamentals that are going to ensue from higher interest rates. All right. So descriptive, predictive, and prescriptive. And I would strenuously, and this is a hill I will die on, and it's one of the reasons Tom is so good. Thornton, he sticks his neck out there. Most of the people in FinTwit, most of the people in the media, and you know how it is, Jack. You read something, the first 2/3 of it is a recant of, oh, this happened and that happened. And then some people come on, they take victory laps. Oh, well, remember when I turned bullish on energy in 2007? Like, who cares? Forward march. Let's look forward. And I would say to you that too many of the, and I don't know how good your Yiddish is, Jack. Yenta, someone who talks a lot. Okay, there are a lot of macro yentas. Okay, who come on and they'll say, "Well, Jack, what you don't really understand is, we've been in. I'm not going to mention names, but you know what I'm talking about. We've really been in a recession for a year and a half, and the thing is, I'm right and the market's wrong, and nobody knows this except me. But just wait until all the data comes out. The jobs data is going to be all completely revised downward, and it's like they're trying to win the IQ contest or cover up or justify the lousy call they made 18 months ago. And that is just I'll go back on the word that Joe seized upon that I use. That's not helpful.
So I think when I've heard Stan Druckenmiller interviewed in honestly all podcasts, and actually he had a great interview on Real Vision, way back in the day. Uh, his interviews about his process are immensely helpful. What he's interviewed on TV and he gives his own positions, I think that they tend to be actually very backward looking. So I remember being on a walking across New York City, across Manhattan through Central Park, and I was listening in 2022 to an interview of Stan Druckenmiller. He actually was interviewed by the CEO of Stripe, whatever his name is, and it was during the bear market, and Stan Druckenmiller was saying, "I think the S&P or the U.S. stock market could be flat for 10 years," and we're up 60% from there, and then we learned 6 months later that he actually was extremely long Nvidia and Eli Lilly and all the stocks that have gone up the most. So he changes his mind like a really
Right, but Jack,
extremely.
that's totally different than saying backward looking. If I'm getting an edge here, it's because I think your sample size is really too short. I've been following for 40 years. Okay, you probably are old enough to remember when last September, when the Fed cut rates and the bond yields went to 360 or 370, wherever they were, and he went out and he said, "I'm shorting the bond market right here, right now." Okay, and that was correct. So I completely disagree with you, Jack.
I respect that. I think he's quote made some great calls, but I think he said that it's about position sizing, how you put
No,
on
but Jack,
the trades, and
Jack, you're talking past me now. Now you're doing what I really don't like. Yes, my friend, I'm copping attitude with you. Okay, he makes prospective calls, but he always tells you he can change his mind 3 times before he gets up tomorrow morning. All right, there's a difference between saying, "Well, he got that one right, he got that one wrong." That's not the point. He tells you what he's doing.
sure,
He
George.
tells you what he's doing and why he's doing it.
What I'm saying is, if he does an interview on Tuesday and he says I'm short the bond market, and then it turns out he made a bunch of money being long the bond market on Wednesday, I'm saying what is the signal
No,
ratio there?
Jack, did I not just say that he changes his mind all the time? He will tell you in the moment. Okay, look, if bond yields go from 360 to 440, whatever they did over the ensuing 3 months post September, if you're if one is the schmuck that's still short the bond market at 440, it's not his problem. I mean, it's like they always say, don't try
Yeah,
this at home. But he is not shy to speak his mind. He also tells you he's a professional investor. He tells you he changes his mind all the time. I find that, and then sharing the thought process, I find that much more helpful than someone writing some folksy 12-page letter where it's like you have no idea what to do with it after you read it.
I agree with you that it's actionable. I agree he's a legendary investor. We can learn a lot from him, and I agree that it's way more helpful that he sticks his neck out, and that he changes his mind. That's what
We
I
agree
agree
on
with
that,
you
then.
on.
That's fine. Michael Kramer, you got a question for Jack? You want to say something, Michael?
Oh no, I just kind of joined late, so I'm just getting caught up to speed here. I've been uh, busy this
Okay. All
weekend.
right. Joe, back to you.
Okay, I want to get Jack's take or commentary really on the 10-year here, which is at an interesting spot, particularly given the market action today. And, it's funny, you referenced this earlier, George, this idea that, which I always was dubious of, this idea that like we want to crash the stock market to save the bond market and bring yields down. I never really followed the logic there. But putting that aside, I'll shut up and listen to Jack. Is Jack talking?
I'm sorry, I was unmuted. Um, bonds are tough. I'll be honest. I'll say my own position. I'm long bonds through like options on fixed income, and I probably slightly down on that. Although actually, I think the like implied volatility has helped me out a little bit. But anyway, I think tariffs again. This is going to change, but uh, tariffs are going to be bad for the economy, and that there'll be they'll basically drag down growth more than they'll drag down inflation. And also, like, I think if the prices of a TV were going to go up 80%, like, I don't think that, oh, people just buy TVs and suddenly the TV, the price of a TV and the CPI is now 80% higher. I think people just don't buy it, and I think that that would be recessionary. Look, I think going long bonds because inflation will cause a recession. That's obviously did not work out well in 2022, but I do think this is sometimes different. So yeah, I could tell you what my position is. I'm long fixed income, but if I lose a lot of money on those calls,
Okay,
at
just
least that
going
means
back,
not
you use the term recession. You said that the tariff's going to hurt growth. What's the impact on growth? How do you quantify that? Is it sufficient to tip the country into recession? You think the tariffs as is right now, based on the limited information we know?
Well, a lot of different estimates. I mean, I'll go with PIMCO that just to choose one number, that for every 100 basis points of, excuse me, for every 10% tariff rates, that's a 100 basis point hit to real growth. And so if the U.S. had a 10% tariff on the entire world, which it does now, except for China, um, that would be a 1% hit to real growth. And okay, we've been growing for 3% in real growth, which is actually very good. Both because nominal growth has been good, but also because inflation has been coming down. So if that's a 2% real growth environment. That's not a recession at all. But I think that you could have some knock-on effects where you know, people who buy in very good sensitive areas, the spending just really, really goes down. People who work at the ports, people who work at shipping, people who work for goods firms, and then there could be layoffs and people stop spending. So I think that yeah, I'm not worried about services other than through a knock-on effect. But I think the goods part of the economy, like if tariffs stayed at uh, even 45% on China, and they stayed at, I guess, 53% China, and where they were at reciprocal levels, yeah, I've been surprised if that didn't lead to a
I mean,
quite a deep recession. Go
aren't we
ahead.
talking about like 15% of imports that are coming from China? I mean, that's what I don't follow here. Like, I mean, I get it. It's a headwind. So let's just be generous. Let's double it, right? If you're going at 3% real and it's a 2% knock on real, right? That's low growth. That's not recession, right? And I guess, can you speak to that a little bit more? I mean,
Yes, sure. So it's a 2% hit to real growth. That would be 1% growth. That would be pretty stagnant. You could have a few, a quarter over quarter, excuse me, two consecutive quarters of real GDP. I mean, the real GDP came in negative 30 basis points because people were like front running all these tariffs. That's an implement, but I think it's closer to a recession than we've had by far. I mean, some people have said that everyone thought, so many people thought there would be a recession in 2022, didn't have one. In 23, didn't have one. 24, didn't have one. I think that if real growth went to 1% and people were having severe price hikes in very noticeable items, I think that yeah, that could lead to a recession. I agree, the absolute effect wouldn't, but I think you could have knock-on effects where consumer spending goes down and investment goes down because of the uncertainty.
so
So
your
I guess I,
your
I
base
agree with you
case
that
is still a recession. Your base case is still a recession, given what we know now.
no, I'd say that I honestly haven't thought about it, but now that you ask me, I'd say no, because the tariffs are yeah, with these current levels of tariffs, no.
So,
But I'm saying the huge hit to growth if those reciprocal tariffs were in place. And President Trump said that they were not a negotiating position, and I took him at his word. And I guess maybe you're right that that's a mistake. But no, a 10% tariff on the rest of the world, if
okay.
that's
All
not
right.
a
Joe,
recession.
let some others in the dialogue here. I want to go to Gnostic and then Nicola. Gnostic, good to see you. You got a question for Jack, Gnostic?
Yeah, I was going to ask him what he thought of the 10-year at its current rate and if that's going to continue to go up. But further to the question that he was just answering, if you don't mind answering the 10-year after this one.
I think Gnostic, I don't know if you were in the room 5 minutes ago, but I think Jack said he actually owned bonds. I don't know if you heard that or not.
Well, I came in late,
Oh,
yeah,
okay. So
but which
if you have
year?
another, if you have
Short
another
term, long
question,
term?
no, he doesn't like bonds. If you have another question for Jack, don't say
Oh yeah.
anything. Do
So
you have another question for Jack?
Yep. Short term, midterm, long term. Then are we in a recession? In which of those three categories do you think a recession would occur? Short, mid, or long term?
I mean, I don't know exactly what your definition of long term is. I think that the thing about tariffs is actually they hit it quite quickly. Like a lot of things, like for example, if Silicon Valley Bank failed, you actually didn't see a credit effect. But I think if you were to see a contraction in credit or a decline in credit, like that would not have been played out until like the end of 2023. But I think the thing about tariffs is that they are immediate because they're just a law. So I think so far in the data, we've only seen a huge rise in imports, not a fall in imports, but a rise in imports as people were front running the tariffs. I mean, that's my assumption they were front running. It's possible that there was just a huge surge for no reason that had nothing to do with tariffs, but that people were front running the tariffs, and so I think that I mean, short term is 3 months. Then I think that they would have caused a recession, but we could have avoided it. I mean, I think Trump is like very, you know, he's doing what he did with the auto tariffs of putting in something extreme and then putting in a 90-day reprieve in order to do negotiation. I actually think that could work. Art of the deal, but it's a little bit frustrating as a market participant as well as a commentator, just because you're kind of being yanked around. But I think they could. I mean, China exports like close to $500 billion worth of goods. That's that's pretty big.
So, I appreciate that. So, hold on one second before we go any further. We're going to go to Niccolo and then Rusty and Deerpoint. Before we do that, I just put it up on the nest for everyone. Jack's YouTube Monetary Matters is a must listen. I try to listen every week that I remember to. So again, it's up on the nest. Monetary Matters. Okay, so we got, what is it? Niccolo, Rusty, and Deerpoint. Niccolo, the floor is yours. You got a question?
Yes, sir. I got a little bit of a comment first before my question. Thank you to the panel. Thank you guys, Jack, Michael, Rusty, Dilly, Joe, Thomas, who else I can't see. So I listen to a lot of the Naval War College, and the primary concern for this year, the next 4 years is an invasion of Taiwan. And I hear all the military strategists say that that is their top concern for this next 4 years. And I think that played hugely into the selection of Trump. You know, from the military crowd, he's a wild card. Yeah, he's definitely dangerous. He might shoot himself in the foot as well as shooting you in the foot. And so I think that was really big appeal in this time of uncertainty. We really want to deter any kind of a hot conflict in Taiwan, any kind of a power move from Xi, and this is his window of opportunity. And I think that through that lens, all of this noise from the administration, all of this chaos, and Trump seeming like he's not knowing what's going on, I think it makes more sense. It's all by design in that you know they want to put China on the defensive. I don't know if you guys ever been in a situation where your significant other or friend starts acting a little crazy, and you're done trying to be the calm one, and then you start acting a little
Hey,
crazy.
Niccolo, can I interrupt for 1 second? Um, Jack is such a rock star. We've got like an enormous room here. We've got 470
That's true.
people. So
That's
I'm
true.
going to ask you, as they say, to please land this plane, and because I want to allow others to speak as well. So, Niccolo, please go for it.
Fair enough. Fair enough. So I am. So I'm curious. Do you think that? Do you think that we will get through this 4 years without any more giant conflicts, or do you see this kind of uncertainty winding up in kind of a catastrophe and a real all-out trade war with China? Do you think he's going to get away with it, or do you think that China's going to take advantage of their position?
I appreciate the question. I've got no edge in geopolitics, and I struggle to just keep up with everything that's going on in financial markets. So I really am not qualified to answer that. I will just offer my opinion that I think President Trump is kind of a blank slate to people. Like if you hate free trade, then he's a total crusader against free trade. If you want to restrain China, then he's your guy. If you want to bring manufacturing back, then he's your guy. If you want to generate tariff revenue so that he can cut taxes, then he's your guy. And obviously, from a negative perspective, that all plays out as well. I don't think that he's. I mean, to me, I think tariffs and going against free trade and thinking that he's speaking that America is being treated unfairly. I actually think that is one of the few policy things that he's very passionate about. So shout out to Joe for I guess reading Trump right over the past 3-4 weeks. But I actually am going to disagree, and I think that I think Trump the tariff lover is not gone forever. I think Trump the tariff lover, we will see him again this year. Would be my guess.
Thank you, Jack.
Okay, let's move on. We got Rusty and then Deer Point. If anyone else has a question, please raise your hand. Rusty, the floor is yours.
Hey, Jack. I appreciate you coming on here and getting yelled at by George a lot. Just kidding. I was kind of curious. I mean, you talked to so many great minds. What have you seen? Just in this is kind of a general question, but their sentiment on how Trump is handling Powell. Do you really get the sense that it's going to phase Powell in his decisions and ultimately whether he sticks around or not?
Thanks. Okay, this, unlike geopolitics, is a question I've definitely got strong views on. I think Trump wants lower rates, and he wants to threaten Powell and fire Powell, but I think he knows that he can't. I mean, I guess he could, but I think he's been advised that he can't. So I think it's very unlikely that Trump fires Powell as I see it now. I mean, anything could happen, and I also think that Powell is not going to cave to political pressure. I guess you could argue, you could ask. It's a fair question. Was Powell influenced by Trump in 2018? But I think with his tenure so close to being over, as well as him kind of having guided the economy through some very volatile periods, and having gotten his sea legs as Fed chair, I take him at his word this time that he and the Federal Reserve is not thinking about politics at all. And I do think here's what is definitely possible is that Trump says the Fed should cut rates. The Fed should cut rates. Ultimately, the Fed is going to cut rates, and so when the Fed does that, there will be conspiracy theorists or people who say he's political. He caved to the Fed, or there are people on the other side who say actually Powell is an agent of the DNC, the Democratic Party, by not cutting rates because the economy is in a huge recession. So Powell's political. I disagree with both of those views. I think he is not. He is not political and not influenced either way, and focused on achieving the dual mandate of stable prices and maximum employment, and as well as the third mandate of financial stability.
I agree with that. That's you had me laughing there. I appreciate you taking the question. Thanks.
Thanks for
Thanks for the
that.
question.
We go to Deer Point now. If anyone else has a question, please raise their hand. Deer Point, good to see you. Please unmute yourself.
Hey, George. Thanks for having me. I just two questions here. So the first, I'll just put up in the nest just for people to kind of see. So I think, Jack, this is kind of what you're talking about after 2008 and the financialization. I guess my first question is, how much of this do you think is essentially Trump and having somebody like J.D. Vance? I know this is a bit political, but being from the Rust Belt, who's gone to these areas and had to deal with the shutdown factories, et cetera, and kind of gotten the net negative effect from globalization, and kind of trying to reshore all of this back into the United States. It seems like that, to me, is partially what Trump's trying to accomplish by this policy is really trying to help the people in the Rust Belt who've been disenfranchised by the globalization. But then kind of the second point is, what do you think that this all means for margins? And I can't remember if it was you or if it was Felix who interviewed Moran, or maybe both of you guys, but kind of on his paper on the effects of, exchange rates and tariffs, and then kind of what you think that this means for, margins going forward? Because I've kind of looked at historic periods of time when tariff rates have gone up or down, and usually it tends to have a pretty big net negative impact on profit margins. For global indices ex the United States. Kind of any thoughts that you might have there as well?
So, the first political question, I think President Trump, uh, he he views things in a very financial way of like, if the U.S. imports more than it exports, he views that as stealing, and he views that as unfair. But I think politically, yeah, I think that tariffs are somewhat popular in the United States. I mean, definitely more popular than you would get if you were watching like the democratically like aligned mainstream media channels or the financial channels. I mean, the tariffs are very unpopular in the financial world, obviously, but I think like if you go on a YouTube video for Fox News. I mean, plenty of people who said who like these tariffs, and also there's a left wing faction in America that likes tariffs. I mean, going back 20 to 30 years ago, it definitely was the Republican Party that was the party of free trade, not the Democratic Party. So I think there's definitely been a realignment, and also that was what kind of motivated my view that the administration would continue in tariffs and not back off immediately, which for a short period of time that view was working, was basically like that Trump's base does not own a lot of Nvidia. Like, Trump's base is not the Republican base of 20 years ago. And actually, I think in this new tax bill, it looked like there wasn't this um, uh, increase in the tax rate of, I think, over $2.5 million from 37% to basically 40%. And you if 5 years ago, 10 years ago, you told me or anyone that it would be the Republican Party that was advocating for increases taxes on extremely high earners, that different. And I know Steve Bannon is a big fan of increasing taxes on the wealthy, and also I think the Democratic Party has been kind of talking a big game about like fighting for the working class, and there are definitely some people in that party, who are elected, who are the real deal. But I think in terms of implementation, it hasn't quite been there. So I think there's a political realignment, and I think tariffs are somewhat popular, or they're less unpopular than like a lot of people who, like, for example, only watch Bloomberg or CNBC would think. And I think they will remain, somewhat popular until there's real economic pain, which we haven't seen yet. As your question about corporate margins, I've got no idea. I've had a really hard time finding uh, like analogies to look for in America, because basically everyone who's been alive, pretty much, even if they're 70 years old, has been alive during a period of declining tariff rates. Like, the only time tariffs increased in the U.S. were Smoot-Hawley, maybe like 1919 or some period in the 1920s, and then like basically after the Civil War. Like, tariffs started really high, in the 1870s, and have basically been going down with some very few exceptions ever since. So I mean, I've done some looking into. There's this economist from Dartmouth. I actually forget his name. It's Douglas something, but he's done some really interesting work on like the tariffs in the 1890s, and basically, actually, like, some of what Trump says about the McKinley thing was true. That, like, actually they did have a investigation in terms of like the surplus was so huge in the U.S. that they had to have a way to, like, what do we do with all this money? But I definitely disagree with Trump that that was when we were the wealthiest ever. I actually think, like, if you look at the number of bank deposits in America, it was like several hundred million, in the like less than $1 billion in that time period. And so that's yeah, not a very wealthy period. Although in terms of real growth, it was very good. But yeah, corporate margins declining. I think that probably will happen with tariff rates, but I've got no historical analog to back me up. But sounds like you do, so I'd be interested in your views on that, dear point.
Yeah, Deerpoint, do you have another question? I think you had two questions, or did you ask both of them?
No, no, that's it. No, I'll put what I kind of worked on up in the top just so Jack can see it.
Okay,
If you
good.
need the data, Jack, I don't mind sending you an Excel file.
So Jack, and we're going to get to David in a second, but Jack, so this, you and I talked last week when we scheduled this space, and I had to come up with a catchy title, so I put, I didn't say the Bears are right. I said, will the Bears be right? So and I'm teasing you, pal. In typical Jack Farley clickbait thumbnail fashion, I didn't answer the question. I asked the question: will the Bears be right? So, do you dare want to? I mean, you said you don't think we're gonna have a recession, and assuming we don't get these reciprocal tariffs, do you dare want to? I don't want to infer what your answer is, but will the Bears be right, or would you rather take the fifth on that one?
I should take the fifth. I mean, I can tell you what I've been doing in my own portfolio of like, I've just been owning less put. Okay, thanks dear much. I've been, I owned a lot of puts going into Liberation Day, which was nice, and I monetize it. Like I feel like it's important for me. Definitely, who I was 5 years ago when I traded the COVID thing. What I did is I went in buying tons of puts, and they worked beautifully, but I never like monetized the puts. So
Yep.
I learned that you have to monetize the puts. So I did monetize some of the puts, and then like those puts have that I didn't monetize have been going down in value. So even though I realize there's what's it called, a volatility risk premium, that basically owning volatility is in the long run a bad thing. Like, and if you're short volatility and I guess delta hedge it, that would be a good thing. But basically, the advantage of owning puts is that if you're wrong, the position will get smaller. Whereas if you're short the market and you're wrong, your position will get bigger. And
Well said.
that is a valuable thing to me. So yeah, I when someone said is there still going to be a recession? Like I said, no, it's not my base case that like, yeah, recession's guaranteed. Because of these tariffs, but it depends on the tariffs. And I wouldn't say, George, that my view is, oh, there's definitely not going to be a recession. I think there's a tremendous amount of uncertainty. I think it depends
Sure.
a lot on the tariffs, and I think it will depend a lot on the news flow. I mean, if 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 I here's the thing, okay, and I thought this like several hundred points in the like 300 400 points in the S&P ago, and I was wrong about it. But I think the higher the market goes, the more strength it gives Trump to go hard on tariffs. Suddenly, you're not seeing as much Scott Bessent. You're seeing a little more Howard Lutnick. You're seeing a little more Peter Navarro, and the tough talk gets there. So I think you could like have I don't know, a range bound between like 4,500 and 6,000, where like what the trade hawks go extremely hard. The market tanks, goes to I think what the lows were like 4,800, and then that causes a pivot that then caused the market to go up to 6,000, and then we kind of get trapped there, and then real growth will ultimately be hampered because of that, but it won't be a recession. So
Yeah. No. I mean, Jack, I think you put it well. It's hard to be super confident about anything. And I just put in the nest. Walter Deemer is one of my favorite technicians. It ain't when everyone turns bearish that's important. It's when they finish selling. And then there's the other one. I'll find it, but it's the role of the stock market to embarrass as many people as possible. It's just the nature of the beast, and so it's it's tough. It's tough. All right, let's go to David and then Nicola for a follow up. David, please unmute yourself.
Thank you very much, George. Fantastic space. I love the information, Jack. Considering obviously you're fairly embedded within one macro narratives and then two macro data, you have a clear understanding of this. So I was fairly curious. What do you think is being underappreciated in economic shifts? So specifically global economic shifts, whether it be deglobalization / reshoring, fiscal dominance, or central bank regimes and or realignment. Do you think that one of these are being underappreciated in broader investment cycles?
I'll say in China, because a lot of things that you said are very true and very important, but they're not underappreciated. Like people talk about them all the time. I would say the consumer stimulus in China, in particular, the stimulus through the banking sector as well as the non-banking sector, basically the private sector. I think that the government is allowing a lot of consumer loans to be made, and I think they're again, this is not coming from any bank. This is just coming from me, like looking at companies and making my own assessments. But I think that like consumer credit growth in China could be growing at like 20 or even 30%. Like I've seen companies that they're growing at 50%. Not that the entire thing is growing at 50%. So I think that like the wheels are off in Chinese credit, and basically like the thing about the Chinese consumer is that they have extremely uh, good credit, and they like the default rates on Chinese consumer credit is very low. Like the default rates on the default rate on some consumers in China who are probably have 1/20th or 1/10th the income of American consumers is lower, the default rate, because the savings rate is so high. And I think that consumer credit, for whatever reason, I mean, political, whatever, has not been a big part of the Chinese growth story. Like, there's a huge indebtedness in the real estate sector, but not so much in the consumer really at all. And I think that if you look at like where the credit is flowing, there's been a total restraint on bank credit to the real estate sector, and it's been a explosion of growth into the Chinese manufacturing sector as well as the Chinese consumer. So the Chinese manufacturing sector is been, I mean, BYD, they're just producing day and night. They're producing all these things, but that helps supply, but not demand. And so that's why, China, as a long problem, has had excess supply and not enough demand. But I think that you are seeing steady growth on the demand sector. So again, like, I'm not saying that's going to be the biggest thing ever, but I think that is, you said when the term underappreciated, you said, that I think that is truly underappreciated. Like, I haven't heard people talk about the Chinese consumer, but I haven't heard anyone talk about the growth in like non-bank Chinese consumer credit. And I've even talked to Chinese experts or people who purport themselves to be Chinese experts who don't know about that. So underappreciated, I would say, is that type of growth.
Okay,
Yeah, Jack,
and correct me. Sorry, just a
go ahead.
continuation here, George. But correct me if I'm wrong here. But doesn't the Chinese demographic actually have a lower propensity to consume credit in that respect, especially on a consumer end?
Yes, and that's why it's growing so much. I don't have the numbers, but if I'm just going to make them up. If U.S. Consumer debt to GDP is 30%, and in China it's 15%, you're absolutely right about that. But China has a lot of room to pick up. Is my point.
Yeah, 100%. Before we go on to Niccolo and then Deer Point, just to follow up on Jack, a good mutual friend, Louis Gav, has talked about this, and I think he's forgotten more about China than most other observers, certainly U.S.-based observers, whatever, know. And he's been singing that tune, and I have a lot of respect for Louis. So I agree with you, Jack. All right, let's go to Niccolo, and then someone else had a follow up to raise their hand. Niccolo, you had a follow up question?
Yes, sir. Thank you, Jack, for your insight. So you were just kind of talking about it, but I want to play that out a little bit further. So, you know, do you think that the market is going to go through this kind of same cycle again, or do you think that they may have sniffed out that the tariffs maybe are more for show? Do you think that say we get past through these 90 days, they ramp up the tariff talk? How many cycles of this could we go through before the market stops believing the wolf is coming?
I'm talking. Okay, no idea, but I think that we've got about 50, a little more than 50 days between I believe it's July 6th, which is 90 days after the tariff pause, which was on April 8th or April 9th. Excuse me. It was a Wednesday. So I guess April 8th. Yeah. So yeah, July 6th. Those reciprocal tariffs on the other countries. So that's every country other than China. That reprieve is going to end. So either Trump's going to have to extend that 90-day thing, or he's going to have to say, up those tariff rates that we saw on that, the big beautiful chart that he held up on Liberation Day. Those tariffs are going to be in place, or he's going to say, no, we've reached a deal. I mean, I think that one thing that's been totally opaque is just the extent to which there have been deals and negotiations. I mean, I know the Japanese delegation has come to America, and Trump is saying everyone wants to talk, everyone wants to do a deal, but there's just been really no color on what that has actually looked like. So I would say that I think it's more than likely that you'll have another tariff panic, but again, that could go,
Yeah.
the market could go up to 6,000, and the panic could go
Yeah.
from 6,000 to 5,700. So
It,
or it could be severely worse. No idea.
Yeah, Jack, I agree completely. I think it'll drive everybody nuts if the market just keeps going, up, down, up, down. Everyone's buying high, selling low, wash, rinse, repeat, and everyone loves a trending market. But that would just drive everybody completely insane. Jack, and by the way, I'm going to stop this space in 9 minutes. If anyone has a question, get your question now because we'll have been going for over an hour and a half. Jack, when you think about, okay, so you've got your central case scenario, but like, if you're going to be wrong, you always got to, hope for the best, plan for the worst, whatever. So that's your central case scenario. You've been clear. You like bonds. Sounds like you're not really too enthused about the market one way or the other. But if you had to say, there's an outlier. So let's say we come back 6 months and I hope we'll do this again in a few months' time. We come back in 6 months, and it didn't work out on the way to the bank. Just like nobody predicted the market was going to do this type of crazy stuff we had the last few months of this year. But if you had to wonder about, well, gee, you know, I can make up scenarios for you. The market's gone up, but too many people sold. Even though the market's rallied, sentiment's still kind of on the bearish side. We're going to go to new highs, blah, 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 blah. Okay. The other way, oh, well, you know what? This tariff thing was really like it was a thing for a while, but it wasn't the thing. Really, more importantly, you look at where we are in the cycle and inflation. Well, you're not going to have a rocketing up inflation, but it's still kind of sticky, and so people can be frustrated by the rate cuts. I'm not saying I believe it's just making a scenario for you. There's no room for really copious monetary stimulus. There certainly is no room for fiscal stimulus. And so, okay, it doesn't have to be a recession, but it's also where's the growth come from? There are really no growth drivers here, and so maybe we have a financial accident. I don't know. So if you have to think about, and there's a question here, speech and a question, as I'm known to do. If you had to wonder about, well, I'm going to be wrong. Are you more worried about things, the bottom falling out, or against all odds, the market's going to be up 20% this year, or anything else you might care to say?
I'd say I'm more worried about me missing something on the upside because I think about an interview and talk about like the potential downside so much. So I feel like it's obviously the definition of a black swan, which I don't even really like as a phrase, but it is that it's unknowable. So you to ask what are the black swans on the horizon is somewhat of a silly question. But I think I have been covering a lot of gray swans about private credit, commercial real estate, credit card. Like I feel like a lot of generally bearish things you'll hear about the economy are just untrue or incomplete. Like, for example, it's very true that delinquencies on consumer credit have gone up over the past 2 years, 3 years actually, but they've gone up from extremely low levels. Like the delinquency rate was the lowest ever in 2021 and 2022, at the beginning of 2022. And so the fact that they've gone from 1.5% to 6%, like the 6% is kind of a historical average. And I think also like we have bigger consumer card credit debt than ever, $5 trillion of consumer credit debt, but relative to GDP, consumer credit debt is not that high. Like I said earlier, like the real growth in consumer credit was like from the mid 1980s to 2007, and I think we're well below there. So I think uh, I feel like what would really the swan that I'm worried about now is the tariffs. I think the labor market is weakening but fine. I think that also like there have been somewhat deflationary signs, but they've started at a time when inflation is at 9%. So that's not called
Right.
deflation, that's called disinflation. And like I think the generally inflation going down and real growth, inflation going down and growth going down by slightly less is going to mean that
Sure.
real growth goes up. So I think I say I'm worried about the case where everything's fine, just because macro kind of is it's always about what's going
Sure.
to go wrong, and I'm focused on what's going to go wrong a lot. And so to me, like the case where things go right and the market's at 7,000 or whatever
Right.
is that they're like Trump has reduced tariffs and he declares victory and tariffs are
Right.
only at 10%. I really if Trump is the Trump who we saw on Liberation Day, I struggle to see the bull case there, but that scares me. The fact that I don't see a bull case because
Sure.
there probably is a bull case. I just can't understand it. I also think that the real art of the deal Trump has done has been with the investment community and just the broad public, not so much like other countries, because to Wall Street, a 10% tariff across the board would have seemed very extreme 6 months ago, whereas now it seems extremely mild. So
Right.
I think that that's a chance that that's the bull case: 10% tariffs, and Trump declares victory, and you get some
Right.
show where
So yeah, yeah.
Japan is driving forward down Tokyo, the streets of Tokyo, but I think that that the real trade is a little bit more complementary, and that like for trade deficits to meaningfully narrow, I think it's very, very difficult.
So it sounds like we actually there could be some white swans flying around as opposed to the black swans. All right, to your point, you got a quickie because I want to wind this up soon. To your point.
Yeah. Just 30 seconds. So, Jack, just a quick question on China. The HIBOR rate, I think today is basis points. I think it's fallen about 97% since Friday. Kind of any thoughts on that? And then the second question, just to this credit, where do you see that credit growth being generated? Because, something I track a lot, China's credit impulse, not still negative. Just give the fact that China doesn't have a large, propensity to consume. What do you make of all that? I mean, kind of my base, the reason HIBOR's fallen so rapidly is to try to essentially help, developers. JP Morgan found a 1% reduction in HIBOR to about a 5% increase in property earnings. But it just also seems like China's kind of this original right where it's taking like increased amounts.
Hey, dear point, you're breaking up. I'm sorry. Dear point, land it because you're breaking up. I know, Jack. Did you hear the question? Because
Yeah,
it's getting glitchy.
but I'm actually glad that it was Deer Point who was breaking up and not my own internet connection. So as to your question about where am I seeing the consumer credit growth, so I'm involved with some very small cap Chinese consumer credit companies that I don't feel comfortable sharing the tickers, but I'll tell you here's the company that is the biggest publicly traded non-bank consumer credit company. It's not big, but it's the biggest. Ticker is QFIN. I have been involved with that name in the past, but I don't currently own any. But that is like if any hedge funds own consumer credit, I imagine it must be that because it's the biggest one. And that's a little rabbit hole that you can walk down and explore. Okay, as to HIBOR, so yeah, there's a lot of interest rates in China, and the People's Bank of China has basically been cutting all of them. Pretty tough for me to see the stimulative effects. Like, there's not a real big correlation between um, interest rates and property prices or reserve ratios and economic activity. Like, the interest rates and reserve ratios have been reserve requirements have been going down, but growth has been going down as well. So I think the stimulus is real. I mean, I think part of it is that the so little of the foreign investors like own Chinese government bonds. I think like your average fixed income fund does not own in the West does not own Chinese bonds. Like I know, Howard Marks talks, Oak Tree, they have a distressed credit thing. They're buying, like basically bankrupt debt. That's a very special thing. So I think that it's kind of tough to gauge, but I think the Chinese economy is doing better than people think, and also like I think
All right.
the death of the Chinese economy has been greatly exaggerated. Let me put it that way.
All right, Jack, we're going to have to wrap this up because you've been so generous with the time. It's over an hour and a half. And, Jaylee, I think we got to start doing these things where we assume things are going to always start 10 minutes late because the connection problems are
Yeah,
so god awful every time. It's horrendous.
we got to bake
Jack,
in 5 minutes for glitches.
hey, Jack, thanks for coming back to your roots, man. Really appreciate it. This has been awesome. And hopefully you'll do this again in a few months. Really, really enjoyed your commentary.
Thanks for having me, George. Hope everyone wasn't too bored, and remember to check out Monetary Matters, my interview with Ken Rogoff, the Harvard professor who talked about the U.S. dollar and his new book. That's in my pinned tweet, so people could check that out. Thanks again, George, and thanks everyone for listening.
Take care. Good night, everyone. Bye bye.